Good morning and welcome to the CREO Medical Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll, and I'd now like to hand you over to Craig Galliford, CEO. Good morning, sir.
Morning, everybody. Thanks for the intro. I'm here obviously with Rich, CFO, who's been with us since we listed the company back in 2016, and who also to my right off camera is Kevin Crofton, who's the new chairman who came in last year. And it's been a breath of fresh air for the business over the last 6 months, fresh pair of eyes. And looking forward to going through the deck and what feels like a pretty exciting 12, 18 months and beyond ahead on the back of a pretty eventful and very productive 12, 18 months that we've just put behind us. First slide really just touches on the vision that Chris, myself and the team had right at the very beginning, which was to deliver advanced energy, the type of technology you see in laparoscopic surgery used all of the time, and bring that to the field of endoscopy, where we can enable procedures to go from patients being treated under general anaesthetic in the operating theatre and to be treated in the endoscopy route, as we see in a vision of endoscopy becoming less a diagnostic profession and much more a therapeutic interventional surgical profession. Therefore, they need these kind of tools. And what we're seeing is validation of that process as we go through the difficult challenge of commercializing this kind of technology in the medical device market. But we've got a huge patent portfolio across these brands, the product brands that we have in front of us. And we're essentially at the point of monetizing, or have been monetizing, all of those, and certainly will be at this kind of, as we go through what feels like an inflection point over the course of the next 12 months. It's the first time in the time that we've been running this business where I've come back from a conference in the US, able to sell all of these products into all of the physicians and the indications that we originally intended to do many moons ago. This technology, this kind of development of market takes time, and we've now done that. We've built some solid foundations with an established global footprint of the initial product, which is the speedboat product. We're now launching that in the EU and soon to be in the US with the spider blade product sit alongside that, which is opening up significant indications. Microplate Fine and Microplate Flex, which is our ablation products for the treatment of early stage cancers in solid organs such as the pancreas, the liver, kidney, which was our first cases with Microplate Fine. And you're all probably aware of the partnership with Intuitive, where they approached us and chose us for their pulmonary ablation program. And it was terrific last year to deliver the first robotically guided ablation in the lung. And since then, during the course of the first few months of this year, we've sold our first product under that program, which is a terrific achievement for the whole company and for the team behind it. So we've got an established footprint. We've streamlined the organization as a part of the nature of where we are, the completion of certain projects, but we needed to make some difficult and challenging decisions to make sure that we're really on top of our costs as we see the business developing. Microtech and the transaction, which was a terrific transaction for us, was a catalyst for some of that, which allowed us to do it in a very cost-effective, swift way, which is better for everybody. There were difficult decisions, but we executed on those. The benefit of that 5 million in savings hasn't impacted on the 24 numbers, but will impact for the full year of 25 and ongoing. And there's some operational efficiencies that will continue to flow through as these products come off. Manufacturing and how we manufacture them changes and evolves. And as we get to 2-3 years from now, and the product roadmap is fully evolved with the bipolar range of products, which is a more streamlined and efficient development program, 90% plus of our products will be outsourced from the business, and that allows us for a much more streamlined business model, having achieved what we've done with the business. Next slide, Paul. So we've got robust growth during the year with the CREO core technology, up to 4 million in sales last year. Again, that was driven predominantly and exclusively through the speedboat range of products, which we launched in 2019 with the initial generation of the product. Struggled through the pandemic like most businesses, particularly as a development business at that stage. We launched the slim version of the product in 2021, the ultra slim towards the end of 23, and other versions of speedboats. That's fully complete that range. But we go into this year again with a full platform of technology that allows us to really leverage that talks to some of the tactics that we've had over the last 12 months, where we've been focused more on utilization on existing customers rather than just blanket finding new customers. Now that we have the broader range of products, just coming back from the GDW, the largest conference in this sector a few weeks ago, we see the power of having that full range of products enabling us to go after more customers, as well as now increased utilization across the user base. The transaction with Microtech, which we announced and completed the binding deal in October last year, subject to clearances through the ODI, foreign investment process, that executed in February with a significant amount of cash, strengthening the balance sheet. But it's more than just the cash it provides. I mean, it's a terrific deal because we bought the business for less than we sold for half of it. Generates a dividend rate that is more than we would have enjoyed at the beginning of the acquisition with the profits that were generated. But more importantly, it opens up a strategic partnership with Microtech, who are a terrific partner, with them being the largest GI business in China. They're the largest Chinese GI business outside of China. Snapping at the heels of some of the bigger global US corporates in the GI space, and together we anticipate that we'll be disrupting that significant space in the GI market. We raised additional funding towards the end of last year on the backdrop of challenging market, challenging macro environment, which we saw coming. We need to make sure that we had the cash balance sheet just in case, and we executed on that transaction in February. So the technology platform is growing. The Comaptive licensing program, we'll talk about in more detail with Ion, but we see that growing with robotics. We delivered a foundational kind of a proof point with the system. So that's now complete back at the end of the year in November. And we published the results of that at one of the biggest robotics innovation conferences in Houston in February. That's driving a roadmap of potential opportunities with Comaptive deals. But our outlook in terms of expectations with our business and with the expectations guided into the market excludes any of those kind of lumpy, speculative kind of deals with Comaptive. That doesn't diminish our ambition that we will secure them. It just means that we're building the business assuming that they're not going to happen, and if they do, we'll adapt the business to meet them, which is a significant change to how we probably positioned the business before, which has helped driving streamlining of the operational efficiency, again, which we've delivered. We also disposed at the end of this year, which was drove Rich slightly mad with the complexities of the accounting that go with it, with the ABA business. We acquired that business because they are probably the leading manufacturer and designer of specific microwave components that we needed in our Chroma platform back in 2021. We delivered that. We've got the IP for the technology with that, and we've delivered the next generation of that to make sure that we've got no obsolescence issues in the supply chain. We don't need that business anymore, so that's been sold back to the management, and in a positive and constructive state. We've got access to all that technology if we need it, but that's all built into the generator, which also now outsourced the manufacturing of. So all the complexities of that have dropped off our operational kind of complexities. Next one, Paul. So the industry we're in is driven by clinical evidence, drives adoption of the technology. More adoption of the technology allows us to generate more clinical evidence with more indications. That opens up access to more partners, more significant customers and key accounts for us. That then helps us to generate opportunities with our Comaptive licensing partners, whether they're within the industry or separate to the industry. And then the more of that we do, the more clinical studies we can generate and so on. So to give you a flavour of that, there's some of the studies that we've got underway on the left. In numeric terms, if I go back 18 months to 2 years, we had 3 sites running with 3 investigators looking into 2, possibly 3 indications in about 2 or 3 countries. We now have 38 investigators working on about 14 to 16 clinical studies. We have 4 registries running, and that's across 11 countries. So the scale at which we're generating clinical evidence is dramatically increasing, which will then spin us back into generating usage, and for not just breadth of users, breadth of customers, but also the depth of utilization in each of those customers. And we're coming straight out of the gates with products like Spiderblade that we started to launch in Q4 of last year in Europe. That's already now getting traction with clinical studies, on some cases on a free and then some cases on a paid for basis. And that cycle will continue. Microblade Fine will be launching clinical studies and registries over the course of the next 3 quarters, which is a really exciting project to re-energize, having delivered the Microblade Flex product with Intuitive. And again, we're generating data with Microblade Flex. We now that circle back into moving to the next stage of commercialization with Intuitive, so that we can start generating post-market cases. And we've got a first sale of that Microblade Flex product at a terrific price point. So it feels like we are really at a strategic inflection point with our product range moving forward. So the technology we have, Speedboat, Spiderblade, Microblade, Fine and Flex, those brands we've been talking about for a long time, but genuinely this is the first time I can sit here now and feel like we have customers engaging with every single one of those products. The markets that we're going at cover bowel resections with Speedboat, which was originally designed for. We've got great data from the NHS here in the UK. We've got increasing data in the US, but there's no reimbursement there at the moment. But we do have reimbursement for that product and the procedures that it is involved in the esophagus and for swallowing disorders, as well as bariatric stomach cases. Spiderblade Flex is the product that really inspires our users to think about other indications, not just some of the things that were originally designed for Speedboat. It was designed by a good friend of mine, Rob Hawes, who is the father of endoscopy. Many see him as the harmonic scalpel at the end of the endoscope. It's a utility for surgical applications, and we're seeing those expansion of the indications coming to life as we've done the first cases with Spiderblade Flex in Europe, and we're excited to see that happening in the US. But in particular, there are 2 or 3 really key indications where we know it's going to succeed, and that will be developing into what we expect to be the exciting and growth driver behind the bariatrics market, where obesity, poor diet, and all those kind of indications, fundamentally it's a psychological disorder that's driving these cases, is going to drive a lot of growth for us. And I think I've covered Flex and Fine with the Microblade programs already, tapping into some significant markets. Next slide. So our user growth, again, we focused more on utilization by customer user rather than just blanket increasing our user base. We did increase our user base as per our expectations at the start. The new products, Speedboat Notch, Spiderblade, Microblade Fine, they will expand the utilization per user as well as additional users. There's numerous sites where we know that selling a system into a hospital with one product is challenging to get through the value analysis committees and so on. But when we have a range of products that sit within all of the interventional endoscopists within a hospital or a chain of hospitals, then it oils the wheels of getting value analysis committee sign-offs and so on. So that, alongside the reimbursement for the upper GI POEMS procedures, which is already driving a lot of demand and usage, and that's partly what drove the notch, stepping it up a notch product, because they needed that extra feature for some of the upper GI cases. That's significant because it'll increase utilization, but it also shows that we're able to add a line extension to our product range in a very efficient and low cost manner. So I think we're in a great spot to continue to grow the business along the lines of what we have in the analyst notes that have gone out today. This graphic clearly shows where we are in terms of the product roadmap. We launched Speedboat Inject, the original Gen 1 product, back in 2019, just before the pandemic. Revenues recovered in 22 after the pandemic. But in the last 2 years, we've been working hard to complete all of the range, which has been launched or is launched as the graphic shows during 2025. That will drive revenue growth and utilization moving forward, which we're super excited about. In the grey is the devices that we're also going to be adding to the portfolio, which is a much more efficient product roadmap driven by partnerships such as Microtech and others, that allows us to attack some of the volume procedures where advanced energy really adds value as well, which will cost comparatively significantly less in a more efficient business model. And we expect to be launching those during the course of the next 12 to 18 months. That completes a range of devices that cover essentially all of the therapeutic applications of energy in the GI market, and allows us to be a substantially significant player and dominate that world of energy in the endoscopy room in the way that advanced energy has really dominated laparoscopic surgery, which is, again, back to our original vision. And we feel very confident that we're on track to do that with the balance sheet to do so. Next slide. Again, just touching on some of the key opinion leaders that we're working with. This is an exclusive list. This gives you an example of some of the case studies where physicians are observing minimal post-procedural bleeding, post-procedural pain with Juwaid and his colleague Mohammed Othman in Houston. Eduardo Albinez, he's been working with us very much on the upper GI, but as well as lower GI cases, but careful dissection of complex areas and how it deals with fibrotic tissue and the complexities that come with patients with all sorts of indications, whether they've had previous procedures or they've just got very challenging lesions. In other cases, we're seeing reduced complications because of the advanced energy where stenosis or the stricturing or the tightening of the esophagus that stops people from swallowing is dramatically reducing the number of visits that patients have to the endoscopy room for what's called dilation, where they put a balloon down your esophagus and force the fibers open so that they can swallow again. That doesn't happen with our technology. But we've got some additional coverage on that later in terms of the clinical advisory boards and how these people are impacting our life. Again, if I go back 3 years, the number of people that we were in a position to talk to do these things for us, you could measure on one or two hands. Now we have 38 investigators just looking at the clinical study program that we're running at the moment, and the results of that will really be felt over the course of the next 12 to 18 months. Next one, Paul. So just touching on the ION program, which is the Microplate Flex product with Intuitive. We signed the original development partnership with them in 2021, and there was 2 phases for that product where there was development milestones to fund that process. So on the right chart here, you see the revenues in 24 and 25 and earlier relates to the development milestones for delivering and execution of the delivery of that phase 2 product with the Microplate Flex integrated into ION. There was an expectation at the time that we would move to phase 3 before we went to commercialization and started to do post-market cases beyond the clinical study. But when we saw the first cases with the phase 2 original product in the end of 2023, moving into 24, there was a desire to switch straight to post-market cases and skip the need for phase 3 immediately. That doesn't mean so it won't happen, but what it means is we can launch into the market with the phase 2 product. Post the end of 24, the end of the accounting period, we've sold the first product into those post-market cases at a great price point. And on that basis, if you look at the cases that the current users are using at, they would annualize at around about £150,000 per annum for that product, just on the cases that are dealing with, and that's within the constraints of the clinical study and so on at the moment. So we're very happy with where we are. We see where the growth is going to take us, and that will be quality growth and revenue, as opposed to great revenue, which is the development milestones. But the reason for that was to get to that quality revenue and product sales, which is what we've now started, and we're excited to follow through on for the next 12 months as we develop those sites. The Comaptive side of the business, we've invested a lot of money in terms of where does the technology go next and how does that relate to the current platform that we have in the GI. We answered those questions last year. The team delivered a terrific outcome. Again, painful insofar as we then had to take the difficult decisions and execute on some of the savings that we needed to make, but perfectly well timed and facilitated by an event that we had at the end of the year where we truly demonstrated the technology in a robotic setting with potential customers. That was published and launched at a conference in February, which is the SAGES Innovation Conference. And what that's driven is a pipeline of opportunity where we know that the robotic surgical tools that will be of in the future need to have the technology that we have, or the capability we have to cut, resect with the jaws in the same way that surgeons enjoy with their harmonic scalpels and so on in the laparoscopic handheld world. They need that in the robotic world. So we've got a pipeline of those opportunities that ultimately may well end up with further development contracts and or royalties at the end. What we are not doing is building any of that forecast or expectation into our forecast, and nor have we built any of that into the way we're resourcing and building the business. We're building the business on the core business. We have minimal cost associated with this, which is selling and developing those opportunities. As and when these things happen, we'll update the market on what we're doing, and the guidance will change. But at this point in time, we are set with core product and where we get to with cash that we currently have and the forecast that we have in the through the analysts. So advisory network, just touching on it again, it's not just one group of advisors that we have helping with our business. We have an advisory board on the pulmonary side of the business, which is in partnership and with our own advisors with Intuitive. We have a GI advisory board in Europe, a GI advisory board in the US, and these are some of the best and most well-recognized physicians you'll see on the planet. They're not easy, they're not difficult to find. Please look them up. We also have an innovation council, which is partly these key opinion leader advisory specialists. But to be honest, some of these guys could do a great procedure if you gave them a blunt stick at the end of an endoscope, because they're so skilled. What we need is an innovation council, which we're leveraging, which gets us into how do we help the meatball, the jobbing endoscopists, the newly qualified endoscopists as they embark on the journey of becoming therapeutic interventional professionals. And that's what we're helping to spearhead. And that feeds into clinical studies, and that feeds into the reimbursements that might or might not be coming into the market. We also then have education committees. We've got 8 people who sit on that, both for GI and upcoming on the pulmonary side as we're onboarding new sites. You know, the proctoring and mentoring of people through those early cases has proven a solid foundation for us in the past to make sure that we don't have, touch wood, adverse events that are reportable. We still haven't had any of those, and hope long may the day be until we do have to report them. There will be one at some point. That just happens to any business. But to have got this far is a massive achievement. If I'd have imagined how far we might get before we get an adverse event back in 2016 when we started, I wouldn't have thought we'd get this far, because this is surgery, and I think that speaks a lot in volumes to the quality of the technology that we have. So the partnership with Microtech. Microtech are the largest GI business, distribution business, Chinese business in China, significant revenues. They've got revenues in excess of $300 million. Most of that comes through from the Chinese market, but they have significant presence in Europe and in the US. It's in their interest and ours. We have a shared goal to grow both businesses. It's a process that we started back in 2023. We looked at a number of credible strategic partners, 2 in particular. We selected Microtech in the middle of last year and executed on a incredible process, really, if you think about the time it took to get to agreed binding terms by October. But there was a sort of 3, 4, 5 month risk of ODI in terms of actually the cash being able to come into Europe to complete the transaction. Hence, we did the top-up raise in November, which I think was the right thing to do, certainly in hindsight, as difficult as it was for everybody. But it gives us a strategic partnership. So not only does it give us the balance sheet strength, we are now actively talking to them and have launched co-development programs with them, which have materially changed the cost base upon which we expect to deliver a new product, which is the beginning of what will definitely come next. We are transitioning product into the CREO Medical Europe business from Microtech, and that process is going terrifically well. What that means is our business, the joint venture, will be essentially selling product that they'll be transferring in at factory transfer prices as opposed to distribution transfer prices. Hence, we'll see growth in the profitability on the current volumes. We also see volumes increasing because of the breadth of the product, and ultimately the access through the sales channels that we'll have across Europe will increase. So what we do have is real clear line of sight in terms of the cash that's generated and the dividend rate that we expect from that business that will grow over the next few years. And that's all part and parcel of our pathway to cash flow break even over the next few years. And then also we still have the other 49% of the business. At some point, we will be very confident of our channel, and we still are in Europe. But the asset that still sits there on the balance sheet is still significantly valued, and we can pull a trigger on that option as and when we choose to. And it's part and parcel of the conversation with Microtech. We don't have to. We're very much protecting the CREO Medical brand and building that business as it stands at the moment, and excited to start looking at how we can, because we have the option to move some of the products that we sell through CREO Medical Europe and sell those through our Americas business, which is going really well. We've got a lot of growth coming through some of the Americas, but also talking to Microtech as we are at the moment to look at leveraging our core product and how that gets introduced into China, and the heavy lift that they can help share with us in terms of accessing a significant market with the product, probably under the Comaptive brand. Next one. Over to you, Rich, on the financials.
Right, thanks, Greg. So total sales in the year were flat at 30.7 million, but that doesn't really tell the picture. The picture now is that we have continuing operations and discontinued operations. Craig's already alluded to the fact that the audit was a bit challenging this year. to get the numbers to where they needed to be in the end. Not because of any issues, just the fact we had to split the numbers into continuing and discontinuing. Going forward, we'll be obviously focusing on the continuing operations. The discontinued operations relate to the CREO Medical Europe, the 51% sale to Microtech. The sales were relatively flat year on year from a pounds point of view, slightly up from a constant currency in euros. It's approximately a 31 million euro business. That business will grow over the next few years in and around sort of 5 to 10% a year. That's because of the relationship now with Microtech plus driving of its own products. The continuing operations, that is our core products that Craig's already talked about. That's the Speedboat, the Speedboat Ultra Slim, the Speedboat Notch, the Chroma platform, and all the additional products that come online. 2024 was very much Speedboat and Chroma. We grew from 2.3 million to 4 million. The margin for 2024 overall was down because we didn't have the 1.7 million of Comactive licensing from Intuitive to boost the sales up to the 4 million that was shown in 2023. Actual gross margin, excluding that Comactive licensing, was up from 40% to 45%, and we expect that margin increase to go beyond the 50% and into the 60s and beyond over the next couple of years as we sell the product at more volume and therefore have the relevant benefit of volume-driven price increases and decreases from our cost base. The admin expenses, Craig talked about the savings we've already made. So the admin expenses for last year were at 23.8 million. We've got 5 million of savings to come through in 2025. That is a full year of savings in 2025. So the admin expenses will be running below 20 million for 2025. That is key for us going into the future, where we see increase in revenues, increase in margin, decrease in costs, and therefore that move towards EBITDA break even over the next couple of years. The remaining 49% stake will also bring in a revenue via a non-controlled interest, and it also bring in cash flows via a dividend. The 49% non-controlled interest will be 49% of the profit of CREO Medical Europe. CREO Medical Europe over the last few years has run on an underlying basis of around about 20% EBITDA. We expect that 20% EBITDA to continue with a continuing increase in revenue for that business. So it should be a nice profitable income stream to us as the CREO Medical Group going forward. So the next couple of slides cover in the main what I've just talked about. We've seen core revenue grow from 1 million to over 2 million to over 4 million. We expect to see the 50% or 40 to 60% growth going into 2025 and beyond. We expect that to happen over the next couple of years as we focused on adding more users, adding utilization per user, and adding more products in. So that's where we see the growth drivers. That's where the focus, that's where the cost is now on the sales team. It's where the cost is on our engineering team and our development team. It's all on Speedboat and the derivatives of the products you've already seen. From a European point of view, this is the discontinued operations, very much flat year over year on a pound basis, slightly up on a core euro to euro basis. Clearly, the exchange rate has impacted us, but we do now have a 36 million investment asset gain sat on the balance sheet that was delivered in February with the close of the deal. You'll see that coming through in the first half results of 2025. But what it does mean is that, you know, from a profitable point of view, H1 will be profitable in 2025, but we'll have to, you know, include this as an exceptional gain on the P&L for the first half of the year. But it does give us that balance sheet strength going into the future if we decide to monetize that asset. Operating margins, just covered that in the main, the fact that our underlying operating costs will be going down by 5 million in 2025. We have been adversely impacted, as previously announced, by the change in the regulations around R&D tax credits. So we've already lost around about 800,000 in R&D tax credits we could have claimed in 2024 versus what we did claim in 2023. We have lost margins from the Comactive side in 2024 versus what we did achieve in 2023. But going forward, all of our cost base, all of our revenues, and all of our projections are based on no more Comactive licensing revenue coming through. we have actually, when we've looked at our cost base, we've not just looked at our cost base from a point of view of R&D and heads, we've looked at our cost base across the range. So that includes re-looking at what we've got from a board point of view, from an advisor point of view, from use of auditors and a number of other areas. So we are looking to make sure that we're as lean as we possibly can, but at the same time deliver the growth in revenue and the growth in the product base that we've already highlighted that we're going to be doing in the next couple of years. Cash, Craig's talked about the fundraiser happening in October. That was a sort of a belt and braces raise to make sure there was no issues with the deal with Microtech that we were doing. We did expect the deal to close during Q1 of 2025. It did close in Q1 2025, but we couldn't be absolutely certain until we got the clearances from both China and from the European countries to ensure that deal was okay to go through. Going forward, we will receive cash from that CREO Medical Europe. There will be a 49% of the profits in the year, and there'll be a dividend declared each year. That business will spin off somewhere between 5 and 6 million in cash per year. Will we receive all of that cash every single year? It'll all depend on how we want to grow that business and the working capital requirements of that business. The majority of our share will be coming through in cash. Is that what we expect?
Thanks, Rich. So this is an interesting slide in terms of how do we get from here to cash positive and a cash generative business. We're a medical device business. It takes a lot of capital to get medical devices into the market. But if I look at this bridge, the items in green are things that are directly under our control or have already been delivered and executed. So the first graph is the cost savings that we've talked about, the 5 million of savings. That's baked in and will happen this year. There's a further set of cost savings which we've already identified that will just happen as we evolve the business and we become a more efficient business, having divested what we do with CREO Medical Europe, as well as how we manufacture our products or where we manufacture those products. We've kind of downscaled the resources. We're back to some of the OGs, we call them, within the company, of the talent within the business as we're kind of coming off some of these projects. But we're going to need that talent to drive some of these programs that we're working with Microtech and other OEM manufacturers around the world, and really leveraging the IP that we've got. But those savings are already baked in. Rich already talked about the cash that comes in through the CREO Medical joint venture with Microtech. And then you've got the revenue growth, which is based on the outlook that we've got, again, which does not include any of the speculative comactive deals. We anticipate that we will secure some of those, but the cost and the revenue are not built into the modelling for that. And as revenues grow, as we evolve the business and become a more efficient business model, and now that we can move into that really hardcore commercialization phase, then we expect to see that margin increase accretive over time as volumes increase. So we can see a clear line of sight as to how we get from here to where we need to be. None of this includes, obviously, the access to the potential sale of the other 49% of CREO Medical Europe. So for me, sitting here now, we're confident that we can deliver and execute on these things with the balance sheet that we have and the access to, if we needed to, any non-dilutive funds that we may need to in the future. And that's part of the strategic deal with Microtech and how that evolves. So we've got a really clear handle on where we need to be. But most importantly, that we get halfway there almost just by the things that we know we've got direct control of and we've got line of sight of in the green. So in terms of the outlook, handily highlighted in yellow. For some reason, we can't get that out of the presentation, but it's an important point. We've executed on those changes. They were difficult. They were difficult for the staff. For any of the staff that hear this, we would thank everybody that participated in the process. It was difficult and challenging, and we appreciate that. And we appreciate the humility that everybody went through that. But it needed to happen, and we were ready for it to happen as part of this inflection point as we go forward. The momentum and the foundations that we built with Speedboat, which is essentially the first and only product that we've been developing the market with and developing those foundational clinical studies that we need to evolve the utilization, is done. We've had a strong Q1, again, largely driven without too much of the new products coming in. What we do have is those new products which are going to really kick in during the course of the second half of this year and beyond as we move into a more efficient product development and product roadmap as we move into some of the bipolar product ranges that help us aid with our current geographical footprint and will enable us to get into areas like China over the next 2 or 3 years, which will be super exciting with Microtech. And we've been able to navigate to this point through some pretty uncertain global economic outlook. We did the fundraise in November, which was challenging for everybody. but it was necessary. We saw that the world was going to be and continue to be challenging, and it was. But we land up in a position where we've got some great products, we've got some great clinical vindication and validation of what we're doing from the world's leading endoscopists, and more of them. And we're very confident about the next 2 or 3 years as we drive towards profitability. I think that's pretty much where we're at.
Thank you, Craig. And before we go into the Q&A, Kevin, I wonder whether you want to say a few words.
Yeah, I'd like to. Since I'm off screen, I'm just going to use my voice at this point. First of all, I think I got to stress it all comes down to focus and execution. And I give credit to the team at CREO. They've really put their head down, their butt up, and they've kept moving. And they've done a really great job at that. And you could tell from Craig's comments and from Richard's comments that the company is at another inflection point with a clear line of sight to EBITDA profitability as well as cash flow positivity. And that's really on the backs of having restructured the business, having resized the business for what it is, having taken out some of the speculative nature of the comaptive product program plans that might have been in place in years gone by. You already saw from, I think, slide 8, where you've seen a whole raft of new products that have been launched in the last 12 plus months that are now in the marketplace and are real. And Craig already mentioned the growth that we have in users. We now got 38 investigators, 14 sites, 9 indications. I probably got the numbers wrong, but it's quite a bit different situation than where we were 12 to 18 months ago. And then circling back on the focus and execution side of things, I think it's important to highlight that the team has executed and has delivered 3 straight quarters of what we said we were going to do. And I expect that that's going to continue. I'm not sure that we can look back in the history and say that we've done that 3 straight quarters in a row. And let's just keep that in mind. It's all about focus. It's all about execution. And I like where the position of the company is. I think you got a really good program going on. So those are my comments.
Thank you. Thank you very much, Kevin. We have some questions, some pre-submitted questions, but also some that have come through in the presentation. The first question, I guess, relates a little to sales forecasts in the past. And one of the investors has asked about the fact that some of the previous forecasts had been not a bit wide of the mark. What was the underlying reason for this? And are you more confident now in your current forecast and outlook?
So I think for me, it's probably 2 or 3 key drivers behind that. One, we've touched on the comaptive speculative revenues that we had reason to expect would happen. With ION, we were expecting and could well still expect the phase 3 part of the program, which would have generated some lumpy development revenues potentially. We also had draft contracts for other development activities, which would have been quite lumpy and high margin, reasonable to expect. But we've taken all of those out, and we've taken, having delivered the contract, the work that we needed to do, but we've taken those out of expectations now to make sure that we've got much tighter handle on what we're expecting. And I would also say we're developing groundbreaking products. So if you look at each and every one of these products, we are the only company that has delivered bipolar energy in the form of spider blade in robotic capability, as well as at the end of an endoscope. These things take science, and we're proving the boundaries of physics. It's very difficult to pinpoint exactly when you're going to be able to do that. So having got those done and got the clearances done, I don't need to make another one of those. I don't need to make another microblade flex. I don't need to, thank God, make another microblade find, the world's finest microwave ablation device. Bipolar RF products become much more straightforward, and we've already got evidence of how they're going to be much faster and easier and much lower cost to execute with a streamlined product range. Having said that, so we missed some of our core revenue, partly because of that. But when you're starting from zero, it's extremely difficult to pinpoint where on the map we're going to be. That's not an excuse. What I do see is constant foundations that are delivering reasons why we can see how the growth is going to layer on the activity that we've got and the results that we're delivering.
If we can stay on expectations, one of the follow-up questions was about if you say in your statements you're in line with expectations or management expectations, it's difficult, an observation from one of the investors, to know what those are. Is it possible for private investors to access, what the market data is, what the forecasts are?
So I think we have part of what Rich touched on earlier on. We've kind of streamlined some of the way in which we expend cash on our advisory network within the markets, but we still have Edison covering. We have a number of other sources of coverage, whether even if they're not able to access Numerus's coverage or some of the institutional houses. If you need more access to data, you'll contact Paul and the Walbrook team, and we'll be able to put you in touch with as much of that kind of forecast data as possible.
Yeah.
I'd also point out that during the course of last year, because of the complexities of the transactions that were underway, we were somewhat hamstrung in terms of what we were able to communicate to different types of brokers in order to get guidance out there. We've cleaned all of that up now, so we're in a much better position to drive that guidance. So if in doubt, go through Paul and we'll try and furnish you with whatever we possibly can.
So yeah, if you email us at creo@walbrookpr.com, the Edison research will be available. Those will be forecasts that can show what's in the market. The same investors asked questions about clinical trial database. There are a lot of trials that are due to report soon or should have by now. Whilst I know from experience trial data is subject to what's best described as experiment error, is it possible to have a rough estimate of when they're due?
So I think Kevin, in an eloquent way, touched on some of the volume of studies that we've got. If I go back 2 years, we had 3 studies running with 3 investigators, 1 registry looking into 2 indications. We now have 14 studies, 38 investigators across 11 countries into 9 indications with 3 registries running, and that's largely been instigated or in the process of being put into place in the last 18 months. So that's a mixture of clinical studies and registries. The clinical studies you can find and research online and see what they are. Some of them have already been published at DDW recently, so we can provide anybody with more information on that. The registries that we're establishing are filling up fast now that we've got more users, and that benefit of the registry is we're not bound by having to complete enrolment with a specific number of patients with a specific set of outcomes. The data is generated and we can mine, and physicians who are participating in the STRIP registry can mine the data and publish in multiple ways. So we expect over the next 12 or 18 months a significant increase in the volume and scale of clinical output over the course.
What do good results look like? And these, when you get the clinical output, what shows that these are good results?
So it varies depending on the product and the indication. Some of them are industry-led, so we're driving an outcome that we want to get because that helps us promote the products. Others are investigator-led, where a particular investigator, for example, in the esophageal space, has seen an outcome and they want to demonstrate that. But most of them relate to better patient benefit outputs. So it's safer and generating greater efficacy data. So if you look at the study that we're running on the pulmonary side, the first and most important endpoint is that it's safe and it's delivered in a safe way. We're delivering that into a world where patients are going to have a treatment and they're going to come back for follow-up. So the long-term efficacy data will take time because we're looking at what's the survival data at 12, 3, and 5 years. So therefore it takes 12 months, 3 years, or 5 years to get the data. But you first have to do the safety data. This isn't unique to us. This is the way the industry works. But spinning that flywheel that we had in one of the earlier slides is really key, and we can see that benefiting across all of the products.
Can we turn to Comactive? One investor's asked, we've obviously had quite a lot of news about the partnership with Intuitive, but what's the situation with CMR? And also, are there any other partners that maybe could happen in the future or on the horizon?
So we had a slide earlier on. We've got a long list of potential partners. We're not investing in the technology. We don't need to. We're investing in essentially one guy to help develop that market with some support from the rest of the business. He personally ran the Hugo robotic program for a company called Medtronic, which is a huge corporate. So there's companies like that. The CMR relationship, they've obviously just recently announced a funding execution. We know that they have energy and products that need to go into their platform, but we need to work with them on what that looks like. But there are 125 startup or emerging robotic surgical devices in the industry, and we're talking to a significant proportion of those. And some are right through to the point where we're scoping out exactly what the nature of the relationship would look like. Some are getting to the point where we need to put some technology into their hands to evaluate. So there's a significant number of those. and then there's a range of others. So we expect some deals to come through, but we're not baking that into our forecasts or financial expectations.
Some questions for you, Rich. There's a couple of questions on cost saving and funding. I think you've addressed them in slide 15 on that, but also on the EBITDA bridge slide. But I think it's useful if we just give us a short summary to answer these. So 2 questions. One was, can you give an estimate for cash overhead base for 2025 and whether you still think you're funded to cash profitability? And then the other one was a question about the underlying cost base in 2024 was 23.8. You have 5 million of cost savings for 2025. Does that mean your cost base is circa 20 billion going forward into 2025? And if so, again, what's the funding situation in 26?
So the easiest one to answer is the second one. So yes, 23.8 was our underlying base for 2024. 5 million saving off that underlying base takes you below 20 million into 2025. We expect further attrition on that base into 2025 and 2026 as we continue to evolve the development of products, the manufacturing of products, and just the general need for cost base within the business into the future. So there's been some more natural attrition off that number. In terms of the cash requirements, right now, we have a strong balance sheet. We have enough funding to take us through for all the revenue growth that we have, the product development that we have, and the general operating cost that we have. That is our aim going into 2026 and into 2027. We need to be successful on our growth in our revenue is the key. If we grow the revenue in line where we expect, and we grow the margin in line where we expect, and we control our costs where we expect, then we are sufficiently funded as a business.
A question on revenue growth, if I can. Core revenue growth, obviously you've put between 40 to 60%. So the question is, obviously that's lower than the growth you've delivered in this period. Why is that? And it's a question about forecasting. Why have you given a range of 40 to 60%?
The range is so that we end up in an area where we expect to be for 2025 without being precise that we will be at dead on 40 or dead on 60. In terms of the growth, yes, it's not as high a growth as in 2024 from 2.3 to 4, but it's still a 40 to 60% growth. We're ensuring that we are driving utilization per account next year. We're driving the new products into each account. We won't see the full benefit in 2025 of the Microblade Flex product, the Microblade Fine product, and the Spider Blade product. They'll be going into early market release or limited market release in 2025. We expect to see the benefits of those coming through in 2026 and beyond. So yeah, we do not expect to see double, 100% growth in 2025, but you would expect to see at least the same level of growth in 2026 and beyond.
Can I keep on the financial question?
You can carry on.
Yeah. There's a question regarding post-sale cash levels. So
yes,
that was reported 31.2. You're now, as of the end of March, 26.5. What was the utilization of that cash in that period?
So we made those 5 million of cost savings towards the back end of 2024. Some of those payments for those cost savings were going through in the first couple of months of 2025. Some of the payments in there are for working capital purposes and then general just business operating costs. We expect to see we don't just expect to see, we are seeing the costs from Q2 onwards coming off in 2025. So our cash burn has been reduced in Q2 2025, and we'll expect to see that cash burn remaining lower for the rest of 2025.
Thank you. Obviously, in the presentation, you talked about what great return you had on terms of your acquisition of CREO Europe. Are there any other parts of the business, one of the investors have asked, where it could be similarly monetized or strategic partners to accelerate growth? You've obviously raised the point you could sell the other 49%, but is there any other?
Yeah, so the asset is the 49%. That's a significant one. But we have an extensive IP portfolio. So we've done a really deep dive, really heavily over the last 9 months, looking at the IP we need, the IP we don't need, the territories that we need. So that's generated measurable savings, but also we do have further savings to go at if we chose to, unless we're able to license or sell off some of the IP that is not core to either the Comactive program that we need, or more importantly, the core product. So there's IP, but there aren't any other corporate entities that we can look at as an asset that we would be selling off or divesting. That was the main strategic goal of CREO Medical Europe.
Understood. We'll stay on CREO Medical Europe. There's a question regarding that figure of dividends that might be returned. You've talked about 5 to 6 million. Is that the amount that would be returned to you, or should we be thinking 49%?
49% of that number. So and underlying, it's a 30 million euro business and growing with a 20% EBITDA. So we own 49% of that 20% of 30.
Perfect. Maybe this might be answered, and you can answer two questions at the same time here. How would you characterise the state of the UK medical device market at the moment? Also, how does that compare with Europe, other export markets, and the US? And then at the same time, we've been asked a question about US tariffs, so I'm sure that would come up in that answer.
You do the first one, I'll do the second.
Yeah, so it came up in one of the meetings earlier today. It's interesting if you look at the UK market. So when it was our home markets where we started first, we sold very much through pioneering physicians who chose the technology. They wanted to deliver cases. They did the hard work of getting into clinical practice to prove the benefits. And then it's taken us time to get to the point where we now have the NHS supply chain data, which is backed and been consolidated with NICE. And that's driving value-based procurement through NHS supply chain into NHS trusts across the UK. It doesn't make it easy, but it just sets a clear platform. And we're benefiting from that. Our most recent customer acquisition under that program, which is a large bulk deal, it was really acquired through the CFO, the financial administrative side of the NHS, with physicians who wanted to do it, but we had to help them do their first cases to just get that their local validation point that the data worked, at which point it was bought for financial reasons and cost-saving reasons. So we see that continuing. The recent changes in the NHS, I think, will be a disruption, but all of it points to efficiency savings, and it all points to the fundamentals of changing the point of care for patients in the UK. In Europe, it's a slightly different situation, and it's different in different markets. So Spain, we do well because it's a similar market where they can buy products and they have autonomy. In France, it's a slightly different market in terms of the tariffs and how they work, but we address that in different ways. We've had some success, particularly in the last few months, with the spider blade product in particular. In Germany, you've got two very distinct markets, which is the doctor's office market and you've got the hospital market. Our products sit very well in the hospital markets, but what we sell within CREO Medical Europe is slightly different. So there's opportunities there where we work collaboratively with Microtech, our JV, because they have particular strength in some parts and we have strengths elsewhere. And in the US, it's very much a private medical market where it's funded through reimbursement through the AMA. We didn't really touch on it too much in the presentation, but reimbursement has come into our world in the upper GI cases, and that's generating a lot of demand for product, which is partly a response to that we delivered the Notch product because it helps with those upper GI cases. So that's successful for us. And we expect reimbursement in the US to come through for the lower GI over the course of the next 18 months. In terms of tariffs, I'll hand it over to you.
I think the simple answer right now is that yes, tariffs will have an impact on us in the US. The devil's in the detail. We don't know whether or not our devices will be exempt. We'll know that over the next few months. We do have a well-defined transfer pricing policy over with the US, so it's not a full 10% of the sales value. It's roughly 50% of that number. But we do have new products going into the US, such as Notch, Spider Blade, Flex, Fine, etc. All of those, we can look at the pricing that we've got in play. There will be a premium for Notch. There is a premium for Notch in the UK already. There will be a premium in the US. So we should be able to eat away at some of those tariff impacts on the pricing strategy that we put in play. But as with probably every other company right now, the devil's going to be in the detail of the final agreement with the trade agreement with the US.
A question from Michael. What are the key risks facing the business, regulatory, IP or otherwise, and how are these being actively managed and mitigated?
So if I look at the regulatory risk, if I cast my mind back 3 or 4 years, the regulatory risk would have been significant because there's huge changes during the course of 2020 in the European regulatory market as the European standards changed from what was called the medical device directive to the medical device regulations, the NDR transition, as the industry calls it. It's been massively disruptive for all medical device companies, and we are through that now. We have a certification for all of our products and MDR, and so that risk is very much behind us. We have one final link in the chain for our US clearance through the FDA, which we expect to with Spiderblade during the course of the next couple of months. Even if there were a hiccup with that, we know exactly what we would need to do, and it would be cleared by the end of the year anyway. So with the regulatory risk fundamentally is behind us. The real risk for us is all about it's just execution and managing the business. Managing, cutting our cloth accordingly. If we grow sales as we expect, we know where we need to be. If we don't, we'll need to change and cut our cloth accordingly. We're shifting to that focus and commercial execution side of the business, and that has driven a relook over the last kind of 12 months at how do we execute on managing our costs as well as managing the growth of the business, and how do we do that?
Obviously, you talk about your move into commercial execution, you're looking to see where your sales are. This perhaps might answer the question. One specific question was, why can't your forecast be more accurate than 40 to 60%? One of the feedback from the investors now, I'm guessing part of the answer is it's a very early stage in terms of commercial launch, so giving a spot-on number is hard. But also, it's common practice within stock markets to provide guidance to investors, right? Is there anything else you can add?
I think I guess in terms of, you can come in after, but my outlook is wherever we possibly can is to be cautious in how we project our growth and our revenue in comparison to where we were 2 or 3 years ago when we were right at the very beginning of what we were doing. And rightly or wrongly, we had some ambitious targets in there with Comaptive. We still have them. We've just taken them out of our forecasts and we've taken the costs out. So being as prudent as we possibly can, but providing a range in terms of expectation given where we are in our kind of early stage.
This goes back to Kevin's point about over the last 3 quarters you've delivered, and you want to be able to be in a pattern and routine of delivering rather than over promising.
Yeah, it's not about undercommitting and over delivering. It's about the fact that if you said it was 6 million, but 2 bulk orders from 2 NHS hospitals came on the 2nd of January rather than the 30th of December, you lose 200 grand.
So it's not just it's because of the dynamic nature of the scale up of the business, it's difficult to pinpoint.
Absolutely.
A handful of things can move the needle significantly given the scale that we're at, and we are unapologetically at that point in our evolution.
We would love to be at 20-30 million right now and be able to move the revenues in and out of each period to hit a precise number. But right now it's a startup, and we need to think of it in that way.
An accountancy question: what are the accumulated losses that could be recognised as a deferred tax asset?
God, it's in the 100 million region of deferred tax asset. Yeah.
Okay.
But right now, I would struggle to recognise that as deferred tax asset until we get nearer to profitability. And with history of profitability, then there will be deferred tax assets that will come in play.
Okay. Question about the products in development. In terms of your roadmap, which ones do you think are considered stronger and weaker?
What, into the new products?
Yeah.
I wouldn't necessarily pick one over the other for different reasons. They are all higher volume, lower price, but still good margin products, less complex than the products that we've developed before, leveraging particularly the RF side of our technology, which is easier for OEM manufacturers to understand and manage, albeit still it's still very unique, but we've solved those problems. The important thing is them as a whole, because with that range of products, and I'm talking to physicians at DDW this year, with those and the interconnectivity we have with our system, it provides a unique set of products that are to address essentially most, if not all, of the interventional opportunities in the endoscopy room. That is a significant position to be in. So one of their in and of themselves, they're important, and they will generate revenue and volumes and help us produce more sales in terms of generators. But collectively, as they come together over the next 18 months, the impact of them all is hugely significant in the market and for us from a revenue perspective.
And our final question is from Ramesh. When is NICE guidance decision expected? when it's well known that CREO products save NHS costs?
So I think what we understand is that there's been a restructuring of NHS in a number of ways, and included in that is how NICE has been folded into the NHS supply chain environment. So it's much more, the drive behind NICE is, yes, it's about clinical excellence, but ultimately it was about clinical excellence and in ways of introducing technology to make the NHS more efficient. And what the supply chain have done is they're going to publish 10 value-based procurement programs, of which we are one, if not the first, and then they're rolling that out through the NHS. So as we see it, the NICE side of things is being sort of rolled into the value-based procurement as part of the NHS supply chain.
Before I hand back to Lily, sorry, squeeze in one question that just came in regarding the dotted line on the EBITDA bridge.
That's zero.
That's zero, so that's cash break even.
Yes, that's break even.
So therefore, you'll be generative, cash generative in 2028.
Yes, by 2028.
By 2028.
Yeah.
Thank you. I'll pass back to Lily at IMC.
Craig, Richard, thank you for answering all those questions you can from investors. And of course, the company can review all questions submitted today and will publish those responses on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Craig, could I please just ask you for a few closing comments?
I think my primary closing comment after essentially starting this journey with Chris, my buddy who I shared a house with as a postgrad all those years ago, going through the journey we've been on. I kind of hate that phrase, but it's appropriate for us, of listing the business back in 2017 with a big ambition. And it feels like we are at that point where we have that range of products, and we have, you know, some of the world's leading and a range of endoscopists to help drive that into the market. So it feels very much to me like we're at an inflection point. And having been through the process over the last 6 to 9 months, you know, we've cleared out a lot of the complexity in the business, because it served its purpose for us, and we're now laser focused on what we need to do. And it feels like at any point in time now feels that the least risk for me in terms of getting to where we need to be. If I go back 3 years ago, we had way more risk ahead of us. If I go back 7 years ago, we had so much more to do in terms of that point about regulatory risk and all those sorts of things. A lot of that is off the table. Now it's just about running the business and cutting our cloth accordingly, and execution, and that's in our gift.
Craig, Richard, thank you for updating investors today. Can I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of CREO Medical Group PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.